Good morning, everybody. So, welcome to February. So, as some of you eagle-eyed ones will have realised, this morning sparks 2 years since I started hosting the coffee mornings. So, as a recognition of this, I am doing my facts this month on the number 2. So, did you know, well, you will have known, because you're all bookkeepers and accountants, it is the first prime number and the only even prime number, because all other even numbers are divisible by the number 2. It is the framework of the binary system used in computers, and in binary code, the number 2 is represented as a 1-0. It is the number of holes in a standard bowling ball, for anybody who bowls. The word 2 comes from the Old English word twa, spelt T-W-A. It is the smallest non-zero pronic number and the only pronic prime number. It is the atomic number of the chemical element helium, which is number 2. In Roman mythology, is centered around the number 2. If number 1 is best, then number 2 is definitely the second best. When it comes to culture and history, there's little attention paid to number 2. Instead, the focus usually lies on the first or third. Interestingly, this seems to be quite often the case with children, with the middle child often feeling left out. It's not always bad though, as they say, 2's company and 3's a crowd. And on that, good morning, Sarah.
Thank you very much, Caroline. I love that.
You're welcome.
And I can't believe you've been our host for 2 years. So thank you very much.
No. Doesn't time fly when you're having fun?
I know. Okay, so just a brief notice from me this morning. I am at the HMRC Annual Stakeholders Conference next week in London. It's an opportunity for me to raise any issues that we have. So I would welcome any comments or any points anyone would like to raise. If you could send that through to marketing@iab.org.uk, I'll collate all your comments and then I can bring them forward. So yeah, very grateful for however you want to contribute or any questions that you want me to share in that space. And tomorrow I'm off to the Yorkshire Accountancy Awards. Mohammed, I shall see you there. So I'm a judge there. So yes, I shall be meeting Mohammed as one of our ambassadors in the evening. So good luck, Mohammed. But yeah, so that should be a really good evening. But that brings us on to awards as well. So I hope everyone's made their applications. Sam's been working hard in the background, organising that, but we would very much welcome all your applications to any of the new categories that we have this year too. So yes, looking forward to that. So that's all from me this morning.
Thank you very much. So without further ado, I'm now going to welcome Paul Lodder, who is the Vice President of Accounting and Product Strategy at Dext. Paul joined Dext in 2021, having previously spent 21 years in practice, where he was a partner heading up the firm's cloud accounting offering. His speaker session this morning will be very much a thought leadership piece on improving recoverability with advanced automation, explaining a concept that he created when he was in practice, the factory, and some of the challenges, areas for consideration and best practice. Good morning, Paul. Are you there? Because I can't see you.
I am here. Good morning, everybody.
Morning.
Many thanks for having me join your session today. Funnily enough, I'm also at the Accountancy Awards, the Yorkshire Accountancy Awards tomorrow night as well.
I should see you there.
So I will get to see all of my old fellow partners from when I was in practice and many other accountants that I used to work with in the Yorkshire region. I'm based in York, so it's only a stone's throw away across to Leeds. But that aside, yes, it's lovely to join you this morning. I'll share my sort of slide deck in a moment. There's not really very much on the slide deck. It's effectively one slide. But what I wanted to talk about was all of the challenges that I often had to sort of go through, some of the issues in terms of all of this sort of digital journey and looking at automation because it's so overwhelming. And I was at a practice which was a large firm, so I spent a long time moving over 1,000 clients across from traditional sort of maybe handwritten records all the way across to it was predominantly Xero was our solution that we used. But I also worked with another 30 or so firms across the UK from sort of sole practitioners all the way to sort of very large groups in terms of helping them of where to start and some of the challenges that arise. You know, I'm not going to sit here and say, oh, it's really, really easy, it's straightforward. We hear this from, and I do work for Dex now, but we do hear about how easy it is just to integrate and away you go and everything is perfect. But there's lots of other considerations that come into play, and things don't always go according to plan. I could probably talk for the next couple of days on all of the issues that I faced, all of the problems that I had, you know, even to one extent of just one team member who actually put in a complaint against me because they were getting more backache as a result of me introducing Xero and at the time Receipt Bank, now Dex. And it was because they felt that they couldn't get out their seat as much anymore because everything was being digitally stored. And that wasn't the case. But what you often find is there's always reasons not to do something or reasons not to move forward. But what it ultimately meant was, over all of the years that I was doing it, was it did help improve overall recoverability, and client relationships also started to really improve as well. And what I ended up creating when I was in practice to help me, and I'll share my screen, let me just move straight forward onto it, was the concept I called the factory. And this I actually built on the back of going into McDonald's one day. And I realized that the way McDonald's was working and the way that McDonald's was operating was actually very similar to how I wanted bookkeeping to work within the practice. And when you go into McDonald's, everything is perfect. Everything is in the right order, you know, from ordering the food to paying for the food to that food being made. You know, they have everything perfectly placed so that the deliverable, the burger that you've ordered, is exactly what you expected. It's met your expectations, and it's being delivered accurately, perfectly, and you're delighted with that. And I took that concept and I linked it back to the factory, because what I was finding is within my factory, I've got sort of 6 pillars, 6 core pillars that I used to call it, from onboarding a client all the way through to the sort of the service that you're providing, whether it's year-end accounts, whether it's the VAT return, whether it's some special work or not. But what was happening is these workflows, these pillars weren't connected. And what that ultimately meant was a lot of time was spent chasing clients, and you'd have all of the information that you thought was needed from your client, and you'd go straight to your working papers. You would start your working papers and find that actually something was missing. And you would go all the way back to pillar 2, and you'd start asking your clients again, we're missing this information, can you send us this? And what happens with this factory process is you're constantly back and forth between the individual pillars. You're spending so much time chasing clients, picking up a file, putting down a file, and it's not efficient. And sometimes that could lead to mistakes, potentially. It would sometimes mean that your client's expectation of the service that you were wanting to provide didn't meet what they were expecting, through no fault of your own, because this is a two-way relationship. So for me, it was very much, when I looked at anything, I always put it into pillars. What am I trying to solve here? What are the challenges I'm facing? And I started very heavily on pillar 2, which I called the sort of transaction gathering, all of the raw materials, all of your invoices, all of your documents. And whether you're looking at something like Dext, Auto Entry, HubDoc, there's lots of data extraction tools out there. I made the strategic decision that that was the starting point for us. This is where we're going to focus. And if we can get the flow of information through more readily, more real time, it ultimately benefits the next 4 stages of the pillar. And we always hear, you know, it frustrates me when I hear the sort of term a lot around provide more advisory services, do more for your clients. You're always helping your clients. You always have been helping clients pre-technology for many, many years. That's what you love. That's what I loved doing as an accountant. So my view has always been the starting point is real-time data collection, trying to get the information in as close to the transaction data as possible. Whether you process it or not at that point in time doesn't matter. But if you've got the information coming through more readily, it means when you get to the bookkeeping stage, you would hopefully have all of the information. This is pulling it all together. You may have a quality control assurance stage. So the reason I've dipped that down one is because there's new tools out there that can start to check the data for you. Like Precision, which is DEX. There's something like Sift Analytics. There's lots of products out there that can help automate the checking. But what it ultimately meant was when you got to the working paper stage, that should be so much more efficient because you've got completeness of records, you've got all of the paperwork that you need. The working papers now is just pulling it together and doing some of those year-end adjustments, which means you get to the final stage, pillar 6, a lot quicker, a lot smoother, a lot more efficiency. And when we built out all of the different elements at my old firm, that's when we started to see the recoverabilities improving. We started to see less time being charged. It didn't mean that fees were changed. Fees were stayed as they were. We were just improving our overall recoverability. But the really, really nice thing was, and this was something which was always so important for me, was it created capacity. We were starting to save time. We were getting through the process far, far quicker. And that time allows you potentially to have more interactions with clients. I'm also a strong believer of how busy accountants and bookkeepers are, that actually it could be me time, because there were so many times I'd be working late, working at weekends. There was never enough time in the day. So more often than not, it didn't mean trying to win more clients. It didn't mean trying to do more special work or offer more services. It just actually meant you may be able to switch off a bit more on an evening, take a breather, have a break. Every business will be different in terms of their strategy there. But, you know, there is a huge correlation between the more interactions you have with your clients, as we all know, the stronger the relationships, the more opportunities that will arise. And having all of this process automated, particularly when we were using Dext and Xero together, it actually built into more interactions throughout the year. And that's what made such a huge difference. And the big thing with all of this is to try and avoid distractions as well. I made my decision of which products are going to sit under each pillar. Every day there's a new option, there's a new solution. You could spend your life just looking at all of these different products. Once you've made a firm choice, don't get distracted by everything else. Move on to the next pillar and see, right, how do we improve that? Now, you may decide you want to start on pillar 1, you may want to start on pillar 5. It doesn't matter where you start. The key is that you're looking at, as I call the factory, having a joined up approach. So we don't have this back and forth each time. You just have all the way through from start to finish. That was everything. I know that's quite a brain dump. This is a topic I can talk about for hours and hours and hours, and all the sort of challenges and everything else. But the factory is something I still refer to today. It's something I do talk about a lot in terms of just having a process, defining the problem, identifying where there may be some weaknesses in the flow, and then work through what are the possible solutions. Hopefully that was of some help, some interest. If anyone does have any questions, I am more than happy to answer any questions.
Thank you for that. There's nothing at the moment in the chat. I've just got a thank you, Paul, from Sujay. So as yet, Paul, you've got away with no questions.
Lovely. Thank you.
Yeah. So at that, anybody? No.
No.
So thank you very much, Paul. Very good of you to come in and chat to us. So I'm going to move on now to David. And David Pegg is the director at Innovation VAT Services Limited, an independent VAT consultancy for business and professionals. David joined the HMRC in 1974, 1 year after the introduction of VAT, and has had a long and varied career, which includes leading and managing VAT practices at 2 of the Big Four. He's a breadth of experience handling issues for SMEs through to complex land and property and international transactions. And in this session, David will be talking about managing VAT for small, medium enterprises with a view to providing a better understanding to IAB members of how VAT works and how to avoid costly errors. Good morning, David. Just quickly, I'm just going to say, Paul, you've got a load of love going on in the chat. Everybody's saying thank you very much. So thank you. Sorry, David, I introduced you and then went off again, but I'm back now.
No, it's fine. It's fine because by the end of this, I don't think anybody will have any love for me at all if I'm talking about VAT. But yeah, good morning, everyone. Thank you, Caroline and Sarah, for inviting me to speak. And again, I'll be sharing some slides in a moment. Not too many, but yeah, as Caroline said, I've been involved in VAT. I know I don't look that old. Some of you may actually want to disagree with that. You can put your comments on if you want. But yes, I joined HMRC in 1974, can you believe? And VAT had come in just a year before that. So I've been involved in dealing with VAT for a long, long time. And I think the advantage I have as a VAT consultant, I guess, is that most accountants I know and bookkeepers I know absolutely hate VAT. They just don't want anything to do with it. I feel the same way, but unfortunately, I'm stuck with it. So, but no, it is a complicated tax, or can be a complicated tax. And the unfortunate thing is, from my point of view, and you hopefully will feel the same, is that nowadays you don't get the same level of cooperation that you once got from HMRC. In fact, it's very difficult to get them to actually explain what their guidance means in a lot of cases, and to help taxpayers to get their tax affairs in order. They seem more concerned with just revenue gathering rather than providing assistance. So I'm going to try and share my slides. If you'll bear with me 1 second.
It should work.
Let me just try. Can you see my slides at the moment?
No.
Okay,
No, I'm just looking at you.
Let me just try again.
Yeah, you're starting to share now. The wonderful world of VAT.
Yes, how about that as a title?
You've
yeah,
got
so,
slides down the side, David. Sorry to interrupt.
Yeah, I'm just going to try and.
I don't know if you want to lose them or if you want to leave them there.
I'll leave them there for the time being, Karen. I'll just click on through it. For some reason, it doesn't seem to.
Just go to slideshow at the top.
Yeah, I've tried that, and for some reason.
They do it at the bottom where you've got the little. You go to the bottom. It's bottom right on mine. You've got a little square with a. Keep going. Keep going. At the very end, before it gets the line. Next one. There you go. Try that one.
I'm glad somebody knows how to do it.
There you go.
Oh, there we go. Oh, thank you. Yeah.
Problem.
Thanks, Sam.
Yeah, so who am I? Just very, very briefly, as Caroline's already mentioned, I've been involved in VAT, I say, since 1974, headed up 2 of the Big Four practices, got my own business, which has been running for the last sort of 7 years now. So I just want to talk very briefly about some of the issues that I come across, which will include things like land and property, talk about bad debts and creditors, some VAT schemes, and then you might wonder why I've put tax invoices on there, but I'll explain that when I get to that particular slide. So I'd say I've been involved in HMRC since 1974, former HMRC senior officer. I've put on that in, they're too old to still be doing this, definitely still too old to be doing this. But bizarrely, I still enjoy it. So that's the reason why I'm still doing it. If I could talk first of all about land and property, it's something I do a lot of work on, is land and property, and it causes a major headache for businesses, surprisingly, maybe in some ways. as I say on the slide here, if you start off on the premise that most land and property transactions are exempt from VAT, which means there's no VAT on the sale or provision of land and property. There are exceptions which I'll touch on in a moment. But if you are actually renting out a commercial property, for example, normally that will be exempt from VAT, but that then prohibits you from claiming any VAT back on any costs that you might have, for example, in refurbishing that particular property or converting that particular property. So there is a mechanism which I'm sure you're familiar with called an option to tax, which is where you notify HMRC that you want to elect to charge VAT on that particular property. That means then that any grant of any interest in that property, whether it's a sale or lease or license of that property, automatically becomes subject to that, which gives you then or your clients an entitlement to recover VAT on costs associated with that building. And obviously that's attractive if your client is charging or leasing a property, commercial properties, to someone who is themselves VAT registered, a fully VAT registered business, then there's no sticking VAT in that chain, and it entitles your clients then to recover VAT on any costs of running, renovating or maintaining that property. An option to tax stays in place for 20 years. Doesn't apply, as it says on the slide, to residential property. A residential property, whether that's a sale of an existing residential property or the letting of an existing residential property, will always be exempt from VAT. And then if it's a new commercial building, a sale of a new commercial building, and by that I mean a commercial building that is no more than 3 years old than when it's sold, an option to tax isn't necessary there because that is automatically subject to VAT. And the reason I wanted to talk about land and property is mainly where clients are moving property, or when they deregister for VAT, for example, because they have to carefully think about what the VAT implications are at that particular point. Particularly so if they've bought a property in the last sort of 10 years and reclaimed VAT on it, and that property has cost them £250,000 excluding VAT or more, because then it becomes under something called the capital goods scheme, which basically measures the use of that property over a 10-year period. So, for example, if on the slide it says, I mean, I get this quite a lot, where a client will say, I want to sell a property. I've been using it in my fully taxable business for the last 6 years, let's say 5 or 6 years, and I want to sell it. I don't particularly want to charge VAT if I can help it. Is that okay? And you can say, okay, well, there's no option to tax on the property, so the sale of that will be exempt from VAT if you sell it. However, as I say, if that has been bought in the last 10 years and cost them £250,000 or more, then if they sell it exempt from VAT, there will be a clawback of some of the VAT that they've reclaimed. I'll just try and give you an example. So if the client I'm talking about has bought the property, using it in its fully taxable business, it's cost £500,000 plus VAT of 100,000, which they have recovered. And 5 years later, they've decided they want to, in this case, they're actually deciding to not sell the property, but move the property up into their holding company. And a lot of businesses do this because they want to protect their assets. So they'll move the property up into a holding company who will normally rent it back down to the trading company, which is fine. However, we have the same scenario. If they bought that property 5 years ago, it's clearly a capital item. It's more than 250,000 excluding VAT. If they move that property up into the holding company without opting to tax, then the trading company will suffer, in a very simplistic example, a 50% restriction on the VAT that they've already claimed. And this catches out businesses quite a lot. So if the solicitor is looking at this, for example, the client will say, yes, well, I've never made an option to tax on the property. So the solicitor will say, well, that's fine. You can move the property without any VAT being charged. But that's it's a dangerous situation to get into. In that particular case, additional questions really need to be asked. The same thing would be, for example, if a client has deregistered or is deregistering from VAT, having reclaimed that on a property. And if they've opted to tax that property, when they deregister for VAT purposes, there is what HMRC call a deemed supply of that property at the point of deregistration. So what does that mean? Well, it means that when you deregister or when the client deregisters, HMRC will say, you've made an option to tax on this property. We want VAT on the value, the open market value of that property when you deregister, which again is a trap that a lot of businesses fall into. So you've got to be very careful when a client applies to deregister to check whether VAT has been recovered on a property and whether there's an option to tax in place on that property.
I've got a quick question there, David.
Yeah, sure.
It's come from Carol, and she says, does the OTT apply to the building rather than the business who registers? I.e., when the property is bought, another company does the OTT transfer.
It is the building. It's not the taxable business itself. It attaches to the option to tax is obviously made in the name of the business, but it attaches to a particular property. So you can have an option to tax on one property that the business owns and not on another. So it's very much property specific.
Thank you.
And then just briefly talking about bad debts and creditors. Again, this is a favourite of HMRC's, where not so much on the debtor side, but it's worth clients knowing, obviously, that if they have a particular debt that's been outstanding and client hasn't, their customer hasn't paid after 6 months, then there is a provision for them to recover or reclaim any VAT that they've charged to that particular customer by way of setting up what they call a refunds for bad debt account within their records, a separate part of their records, posting the transaction into that account, and the VAT that they've already charged to that particular customer can then be adjusted through the VAT return by claiming that VAT back from HMRC. HMRC's favourite, though, is to look on the flip side and say, well, let's have a look at your outstanding creditors. Same principles apply here. If the creditor has not been paid for more than 6 months, HMRC will say, well, that VAT then that you've claimed must be repaid back to HMRC because you've not made payment on that particular invoice. If subsequently there are any receipts or payments made in respect to those transactions, then the transactions can be re-entered back into the VAT records and the VAT adjusted again. But it's a favourite of HMRC looking at particularly the outstanding creditors, and that's one of their easy assessments. They will go and look at that and disallow any VAT that's been claimed that's more than 6 months old. There are a number of VAT schemes, and again, I could, like Paul was saying, I could talk for several days about different VAT schemes, but it's worth just touching on a few. I think you'll be familiar with these, I'm sure, but the flat rate scheme is not as attractive as it once was. They introduced something called a limited cost trader, which has basically negated a lot of the benefit for businesses who have got very little in the way of input VAT. For example, consultants. A lot of consultants were using the flat rate scheme when it first came in because the percentage that they were allocated under their trade sector was quite favourable. So the flat rate scheme works by just applying this percentage to the VAT inclusive turnover of the business. There is no input VAT recovery generally unless it's on capital assets or on VAT that's been incurred before registration. But that's been more or less done away with now with the introduction of this limited cost trader criteria. The benefit of using the flat rate scheme, as I said, is very much diminished. It's still worth a look for your client's particular business sector, because in some instances there's still some advantage to be gained, but it's very much reduced from what it once was. Cash accounting scheme is, as it says on the tin, your clients will only pay VAT when they are paid by their own customers and not on the invoice date. on the flip side, the client can only recover VAT on purchases if they have actually made payment. But again, for some businesses, it's worth looking at that because it avoids VAT debts anyway, bad debts. So it's certainly worth a look if clients are experiencing problems with getting customers to pay within a relatively reasonable period of time. It's worth looking at that. Taxable turnover limit must not be more than 1.35 million. But I think that's probably going to apply to most clients that we deal with. Annual accounting, again, it's a scheme that really is there to assist cash flow more than anything. So what you do, rather than rendering VAT returns every quarter and paying VAT over to HMRC, you can spread that out over a year by making payments on account during the year, and then doing one VAT return, or the client does one VAT return at the end of the year and makes a balancing payment at that time. And for some businesses, that's quite useful because then it's not up and down all the time in terms of how much VAT is going to be paid to HMRC. It sort of evens out the VAT liability over that year. Same turnover threshold you will see as for the flat rate scheme. Sorry, for cash accounting, I beg your pardon. Second-hand margin scheme, again, probably teaching you things you already know here, but second-hand margin scheme is useful for businesses that are buying in and reselling, again, as it says on the tin, second-hand items. They only, the criteria has to be that when they buy the item, they are not paying VAT on it. So it's either a purchase from a private individual or from some other business that's not VAT registered, or someone else who themselves are using the margin scheme. And then VAT is only payable on any gross margin that is earned from the sale of that item and not on the full sale value. So rather than adding 20% on top of the sale is just made inclusive of VAT, but your client rather, will pay VAT just on the gross profit margin. And a sort of spin-off from that is the global accounting scheme, exactly the same principles as the second-hand margin scheme, but this is for much lower level purchases, where, for example, one I always think of is where you get like a car spares shop, for example, who buy in and resell loads of spare parts. They get them from scrap yards and all sorts of places, and they refurbish them and then sell them on. And if they're no more than £500 a time, which is normally the case, they can use this global accounting scheme, which again only taxes VAT on the margin, but it's slightly better than the second-hand margin scheme, because under the global accounting scheme, you can offset if you make a loss on one sale and a profit on another during your VAT return, then you can offset one against the other, which you can't do on the second-hand margin scheme. They look at it very specifically on individual transactions. I've mentioned the tour operator scheme because this is something that's in the headlines at the moment from a VAT point of view. There's been a case that's gone through the courts relatively recently where businesses are using the tour operator scheme again because it only taxes VAT on the gross profit margin and not on the sales value, and also because VAT registration is not required under the tour operator scheme until the gross profit margin reaches 85,000 and not the turnover. And we've seen a lot of what I would call rent-to-rent businesses starting to use tour operator scheme. So they'll rent a property in, and it could be for furnished holiday lets, for example, rent a property in, and then they will supply the other services connected with that and rent it on to you and I for a weekend or whatever it may be. And under that scheme, as I say, they don't have to register until they hit 85,000 in gross profit, which for a lot of businesses makes the difference because the margins are so small. I mentioned at the beginning just why I wanted to talk about tax invoices, and I only mention it because HMRC are having a big drive on this at the moment. I've got a client, for example, a business who have been buying items, luxury goods for that they export to China, buying sort of handbags, shoes, and that sort of thing from Harrods and Selfridges and all sorts of places. They've gone in and they've got quite a detailed sort of till receipt for these items. clearly exported them to China. There's no issue about that. But HMRC have said, here's an assessment for £1 million because the receipts that you've obtained are not in accordance with the law. And what they mean by that is, even though it's a detailed tax receipt, the value has been more than £250, as it says on the slide, and therefore they require to get a full tax invoice, which I'll come on to in a moment. They've never been told this, that they need a full tax invoice, either by their accountant or indeed by HMRC. But HMRC have gone back 4 years and raised an assessment for over £1 million. So there is provision, obviously, to get what I call less detailed invoices or simplified invoices up to £250, excluding that. And that covers, your day-to-day expenditure for your client. That's fine as long as they have those. But in all other cases, then HMRC are now getting quite insistent on a full tax invoice being provided. They can accept alternative evidence, but it's a bit of a struggle with HMRC to get them to accept anything other than a proper tax invoice. And the other key point, just at the very bottom of the slide, is again now concentrating on what they call due diligence. When a client takes on a new supplier, what checks have they actually undertaken on that particular supplier? And if they haven't undertaken, in HMRC's views, adequate checks, then they can disallow any VAT that client has recovered on invoices from a particular supplier because they suspect that there is some sort of supply chain fraud taking place. So it's very important for clients not only to get the proper invoices, but also to check and do proper due diligence on that particular supplier. I put that on at the end. That's just what the details that need to go on to the simplified invoices, retailers' invoices. And at the very end, I've just put here all the information that HMRC insist must be shown on a full tax invoice. They can be very pedantic about this, by the way. They can insist that if all this information is not on the invoice, that it's not a proper tax invoice. And unfortunately, this is in the law that this information must be provided. So clients need to be fully aware that it's critical that they get the proper supporting documentation when they're trying to recover VAT.
Can I just say, Rachel's put in the chat, this is shocking about the tax receipt. We had an inspection for a client recently and they pulled us up for not having all the paperwork Dexter auto entry. They'd been uploaded manually.
Okay. Yeah. Yeah, it seems to be a bit of a thing with them at the moment. They seem to have, and they do this obviously from time to time, they'll either concentrate on a particular trade sector or they'll concentrate on a particular aspect of the tax, which they are doing at the moment with invoices, purchase invoices. They're having a big drive on that. I've had a number of clients being pulled up fairly recently. And yes, in some cases, it's possible to go back and get replacement proper invoices, but it's the real hassle factor. And in the meantime, HMRC are saying, well, we're going to disallow the VAT until you get a proper invoice. And so,
yeah, Rachel said, do Harrods and other retail stores provide such a full invoice?
Well, this is the key. You have to make them aware. They do, but you have to ask them. You have to tell them that you're in business and you want a proper VAT invoice. Because I've had conversations with Harrods and Selfridges, and they say, for example, in the case that I'm quoting, I said, well, can you replace the till receipts with proper invoices? We can demonstrate this is a business purchasing. No. They said we'll only issue the invoices at the time of the transaction. We were not prepared to go back and reissue. So it's a real problem. But yes, the answer is yes, they can and have to. If you're a business, you can insist that they provide a proper tax invoice. And they have the ability to do that, but they're just not asked for it.
Can I just take you back to buildings? Because Carol asked another question.
Yeah.
For new builds less than 3 years, which are automatically registered for that, do you need to put in an OTT in place after the 3 years has passed?
After the 3 years, if you're looking to sell that particular commercial building or lease it out, and you're looking to make sure that you don't suffer any VAT restriction on any costs associated with that building, and commercially it's acceptable to the purchaser that you're going to charge VAT, then the answer is yes, an option to tax must be made after the 3 year period. I say must be made. It should be made if it's going to suffer, if the client's going to suffer any VAT restriction as a result of not opting to tax. But it's always, in these scenarios, again, the client needs to look at, obviously, who's buying or leasing the building. Are they a fully VATable business? Are they going to object to VAT being charged? And make their decision based on the commercial drivers more than VAT, I would say. But obviously VAT plays a part in that.
And then just quickly, Joe's asked, can you explain what sort of checks HMRC would find acceptable for due diligence on a new supplier? I'm firing questions at you now.
Yeah, they will normally. There is a list on the HMRC's internal manuals on the sort of things that they look at, but they will, for example, say you need to really meet that particular supplier. You need to actually see them face to face. You need to do credit checks on that particular supplier. You need to check their VAT number, because again, part of the problem in the past has been certain suppliers have used invalid VAT numbers, or indeed they've used VAT numbers that belong to a business, a valid number, but that business has since deregistered for VAT purposes, and they use their number fraudulently. So HMRC would say you can go online and do a VAT registration number checker. You can put that detail in and see if that comes up with the same business that you're dealing with. But they normally will insist that you get a full credit check undertaken. That's the main thing. A full credit check, meet the supplier, check their VAT number. They don't expect you to, you can't go to the nth degree with these sort of things. You have to be just reasonably satisfied that this person is bona fide. And again, as I say, there is something on the HMRC internal manual. If you have a look on the HMRC VAT internal manual and look at, if you enter in, post in due diligence, you'll find a list of the recommended things that they suggest that businesses do.
Excellent, thank you. I'm just going to say, because a few people have asked for your slides, so I'm just going to read this out. But if you go to www.iab.org.uk/coffee-morning-2, the number 2 is everywhere. You'll find the slides later, but obviously they won't be there immediately. And yeah.
That's me. So, but again, like Paul said, I'm very happy if there are any questions either now or later. I'm very happy to respond to anything if anybody's got things that they think about.
No, that's been brilliant. Thank you very much, David.
No
very informative. A few people in the chat are going to have words with clients and get things up to date. But yeah, thank you very much.
Good. Okay, welcome.
Oh, might have a question for you. I took a new client and found out he was doing VAT invoices with his UTR number. He genuinely thought he was doing the right thing. Oh, bless him. Yeah, I hope you got him sorted out, Christina. But yeah, just lots of love, and yeah, thank you very much, David.
No worries. Okay.
On that, I'm going to move on to Kerry, who I'm hoping is here, but I haven't seen yet. Are you there, Kerry?
Yeah, I'm here.
Oh, there you go. Are you all right?
We've still got the screen share, so you probably can't see me.
Yeah. Can you stop that screen share, please, David, for me?
Sorry.
Whoa, there. Right, if you speak now, Kerry, we should be able to see you.
Hello, everyone. Nice to see you all, and what great information. Thank you, David. That was really helpful. I've got quite a few things. I'm conscious of time, so I'm just going to do sort of some headlines of some key things that are coming out at the moment for you all to be aware of, and then we can address some of this in more detail over the coming coffee mornings. But firstly, the latest employer bulletin for February 24 was launched last week, and it's got a lot of information in it. You can find this by going on the gov.uk site, or you can just Google HMRC Employer Bulletin and then you can read it. There's a lot for the new tax year that's of course coming up, but just really to recap that as of the 6th of January, the national insurance rate changed for employees. So if you haven't updated your software, just check that you are on the latest edition of your software before the end of the tax year to make sure that the national insurance is correct for the January, February and March payrolls. So that's that. Most softwares are updating automatically, but depending on what you use, you may have to physically download that. There's various different updates on here, national insurance being what's happening right now, but in April there is going to be a change to paternity leave. Up until now, paternity had to be taken as a 2-week block. You can now split that, so you can have 1 week at the time the baby's born, for instance, and a week a bit later on. And all the software is going to be updated to enable you to set that up. So just check that out. That's a really good change.
Just quickly, Kerry, is there a time limit on taking that second week?
Well, I was having a look through it, and I believe it's during the same maternity period, so it's the same as SMP, that you can take that. But as I say, it's all being launched now, so just take a look through. There's also so the reporting of expenses and benefits, so the payrolling of benefits. This is going to be mandatory from April 26th. So everybody has to have any benefits payrolled for the 26-27 tax year. Now you can start this process now. You have to register before the 5th of April if you want to do it for the 24-25 tax year. At present, for payrolling of benefits, an employer has to register with HMRC, so they have to have a government gateway access for their PAYE scheme and elect to payroll the benefits. I've been part of a focus group about the payrolling of benefits and how this is going to be launched, and one of the things that all of us agents that are on that call are saying, we want agents to be able to initiate that process, because a lot of clients don't have their gateway or they haven't got PAYE set up on it. So good news, that is coming in, but it's not going to be in place for the April 24. So it's coming in for agents to be able to elect for the April 25 tax year. But I'll let you know when that's in place. But certainly right now, if you want to do it for the next year, then now's the time to start doing that. There's also a change that's hot off the press. It was only published on the 19th regarding the benefit in kind on whether a double cab pickup truck is classed as a commercial vehicle or cars. Now, back in 2020, there was a lot of legislation around this regarding whether a double cab pickup was commercial or a car, and they finally decided that it needs to be taxed as a car, and from July 24 it was going to be taxed as a car. But they've now changed it. I see Sean's just put that link in to the chat, that they've now reversed that and done a U-turn as such, and it's now going back to being a commercial vehicle and taxed as such. So if you've got any clients that have those as company cars, they are treated as commercial rather than a car for tax purposes. Okay, so that's a little bit about payroll and benefits and the sort of double cab pickups that's changed. Making tax digital for income tax is coming, as I'm sure you all are aware. Myself and Sarah have been involved in co-creation sessions. I've got another one this Friday where agents are heavily involved in helping to deliver what the process will look like, what the guidance will look like, how to make it a really simple process when it's launched. Now, there's going to be a lot of opportunity for testing from April 24. So HMRC need as many clients to be put through making tax digital before it's launched, so that they can iron out any software issues, any feedback can be taken on board. So I know that some ambassadors have been reached out to in the past to sort of help with some of the feedback sessions, and as we know more, and if any members want to get involved further in doing some of the beta testing with some live clients as such, and actually start using Making Tax Digital before its launch, then we will, of course, reach out to you all to give you more information about how you can get involved. You'll be hearing a lot of this over the coming coffee mornings. Talking of that, so following on from David's session, agent access for that has changed, or the way that you can request agent access for a client to act for them as a VAT agent. Once upon a time, you'd log into your government gateway, you'd go to manage your clients, and you can request their VAT access, which will send them a code by post. That's stopped. There is no option anymore to do it that way. That's been turned off. Now you have to send them a link through your MTD agent account and provide a digital handshake. So this will be a link that you send to your client. They then click on it, which will take them to their own government gateway, and then they confirm electronically that they wish you to be their MTD agent for VAT. So it's crucial that that is what happens, otherwise you won't have access to file VAT returns. It's also crucial to make sure that the client has their own gateway for that, which quite often, if clients have been a legacy client that literally has only had their agent look after them, may never have set up a government gateway for their business. So it's imperative to make sure that they have that. There is also, I wonder whether I can just share my screen. I've been on an agent forum, and I found out something new, which I want to share with you. So, and it's, thank you. Okay, can you see my screen?
I've got black, yes. Check HMRC's current performance and service levels.
Yeah, so I didn't know this existed, and many of you may already have done, so I've learned something new. But you can search that you wish to see, just put HMRC service levels, and it takes you to this screen. And you can then check where they're at with dealings with certain things. So you say that you're an agent, you don't have to, you just tick the box, you don't have to verify that you are. But this is updated in real time, and it's all the different services that is often looked at. So say, for instance, you wanted to see how marriage allowance claims are getting on. You can then check that they're currently delayed, what date they are still dealing with, so that some are taking longer. Tax return amendments within 15 working days at the moment. Penalties, normal service. So this is really useful if you're actually dealing with any of these kind of tax related situations. You can then get an idea of what their service level is at the moment for all the different issues that you may be trying to sort out. So if anyone knew about that, then brilliant, but I literally have only just found out. So hopefully that's useful to a few more of you. That's really it from me right now, with just the headlines of what's coming out. But certainly check out the Employer Bulletin. I will put that in the chat as well. And then if there's any questions for anyone, then just give me a shout.
There is, Kerry. Oh, my chat's gone. Where's it gone? There it is. Right, sorry about this. All good things. So Sean put in the link for the double cab car. So it's www.gov.uk/government news update -on HMRC double cab pickup up guidance.
We do this for you, Caroline, to read out.
You only do it so I have to read them out. I love it. Any upcoming coffee mornings, Diane? I think Sam's answered you for that. She's going to look into it. Nikki said, interestingly, I currently have someone off on his second week of paternity. Baby born first week taken on the 1st of November, and it's up to 12 months for it to be taken. So thank you for that, Nikki. There is a question somewhere. Thanks, Kerry. Thank you. Thank you. Oh, no, it's gone. Sorry, Kerry. I'm sure I read a question. Let me go back through them again. Cost of double taxed people with vehicles. Mandatory. Cost of double taxed people with vehicles in the first year of mandatory BIK payrolling is too high for employees. How will they address this? Any ideas, Kerry?
This is something that actually got brought up, and you can, so I'll give you a live example of a client that we're already using that we payrolled then in the second year, and HMRC changed the tax code in the year that you're payrolling to a standard tax code, so you're not actually taxed twice because they're taxing you. What normally happens is you're taxed for the prior year when the P11D goes in, so your tax code changes. But when payrolling of benefits comes in, your tax code then becomes a real-time standard tax code, because the reason they change your tax code quite often is to assume so you're taxed on what they think you're going to be taxed for your car. So by putting you back to a standard tax code in the year that you're payrolling of benefits, you're taxed through your payroll rather than through your tax code. So you're not taxed twice because your tax code isn't, say, 400L and your tax through payroll of benefits. Your tax code would be 1257L and the tax on it works. So I'm trying to think how best to do it, but I thought it would be double taxed, and it actually isn't. It's the way that they deal with your tax code. But what I'll do, and I think someone said about having a session on this, I think it would be a good option to have someone come in to talk about payroll benefits. We had it from CIPP a few coffee mornings.
Yeah, CIPP come in, 1 year.
Yeah, so I think it's probably quite good to bring that in, as this will now be mandatory for everybody to get familiar with it.
And Kerry's posted a link, I love a link, www.gov.uk/government/publications/employer bulletin, February 2024, if you want to have a look at that. Kieran, I'm still unsure how MTD for income tax will work when you have a fair amount of clients, but it's only you in the practice. I did bring that up in the consultation period, Kieran, because I'm in that boat. There's only me with a few clients. Because are they still saying that you'll only have a month to get the MTD in?
A bit like VAT quarters. So say for instance someone is their tax is the 5th, 6th of April to the 5th of April, then your quarters will be the same months, and then you'll have a month. You've got until the 5th of the month following for the quarterly updates. And it will be initially mandatory for turnover of 50k, and then they're still discussing the whole 30k thresholds at the moment and when that will come in, but certainly 50 is at mandation.
Yeah, I think it's going to be up to us as agents to stagger our clients throughout the year so that we're not just working every 4 months.
Yeah, but you can't, the MTD periods will be fixed. So
right. So we are going to just work every 4 months.
They will all be the same quarters, every client, they will all, because it's done per tax year quarters, not like VAT now where you may have clients with different VAT quarters. However, I'm on the meeting that all of these things are things we're discussing. At the moment, there's a big thing about automated quarterly updates, which personally I'm not sure is a good thing, but it's to try to capture so that a submission still goes in based on the data that's in the system. But feedback from any of you like this is crucial so that we can feed that back so that it's looked at.
Yeah, what would be ideal, Kerry, is if you got 3 months to file that quarter, because then you could, but I'm sure it'll work in the end.
Yeah, they are going to now look though at it being cumulative. So beforehand, it was always you did your quarter, and then the next quarter would be everything was in isolation per quarter. Whereas now it is being done a bit like a VAT return where late claims can come through into the next quarter. So it's always cumulative, just so that you're not constantly checking back. And if you found a receipt that belonged to a previous period, it now can just go in cumulatively. However, I hear what you're saying. It's, the work steps up for clients that you may only have looked at annually in the past. So,
and I'm going to stop it there. Unfortunately, we've run out of time this morning. But thank you very much to all our speakers, to Paul, David, and Kerry. and Sarah at the beginning. It's been a really good coffee morning. So the next coffee morning, if I can find it on my bit of paper, is the 20th of March. So I look forward to seeing you all then. And thank you very much for this morning. Thanks, guys. Bye.
Bye.